Hello and welcome to another video. Today we'll be looking at a strategy you can use to trade XAUUSD, that's gold. Okay, on the screen I've just entered a buy position on a mini account and a micro account for gold. Entering another position to delete the first one. So I'm trading on a micro account. I've just placed a buy entry. Okay, if you do not have enough money or capital to trade, do not trade gold. Do not trade gold if you do not have enough capital for your trading. If your capital is less than $300, do not trade gold on a standard account. Rather go for micro account. Like this is a micro account. It's a cent account. It's a $70 account. Okay, so that gives me 7,000 micro amount. Okay, so that gives me enough room to explore and then place, trade, and practice so that I'll understand how trading works. Okay, now for this strategy, we will be using Grail Hedge Strategy to scalp gold profit. What I just did is placed a trade 0.10 as my buy trade. I've placed a buy trade and I'm hedging it, placing a hedge trade like a martingale 3 times the 0.10, which is 0.30. So I'm about to place the edge trade. The edge trade is a sell stop order. So the spacing is about 47 to 48 pips. My zone recovery for the hedge. Zone recovery or spacing where I have my entry, then I count some amount of pips and place the pending order for my hedge trade. So that's about 47 pips. We are trading gold, so you need enough allowance, you need enough room for price to range before it triggers your pending order. So for this example, my zone recovery is 47 pips, like I said. So with 47 pips, I believe my take profit for my first trade, which is a 0.10, will be tripped before price, get to my sell stop order below. Don't forget, the original trade is a buy trade, 0.10 lot size, and the cover or the insurance for that buy trade in case I have drawdown or in case price goes against me is a sell stop order. As you can see on the screen, 0.30 lot size. Okay, so what the implication of this is, if price instead of going up, if it starts to come down, it will trip my sell stop order and I'll have 2 trades running. So I expect price to continue to go down so that the sell stop order, which is a bigger lot size, will help me to recover my account loss or drawdown. So it's called Grail Hedge Strategy. Grail Hedge Strategy is a very good strategy. You can use it to trade gold. You can use it to trade forex assets such as Euro USD, GBP USD, USD JPY. USD, CAD, and other forex assets. Then you can use it to trade indices, synthetic indices such as volatility index. And now looking at the trades, I've placed a buy trade and I've placed a sell trade. I have a drawdown of 7 points, around 6 cents. Okay. Price is ranging upwards. So look at the price is ranging upwards. So I expect that I expect that price will go up and trip my take profit, and I expect that price will not come down to trip my pending order, which is the sell stop. If price should come down to trip my sell stop, then I'll have to place another pending order above, which will now be buy stop, almost exactly where I have the current buy order. Okay. And Grail Hedge strategy involves you placing the opposite trades at some measured points or pips away from the original trade. You place the opposite trade with lot size multiplied by 3. So currently I have a buy trade running, and 3 times 0.10 for my buy trade is 0.30. So if that's 0.30, which is a pending order right now, if it gets tripped, it instantly becomes a running trade. That means I'll be having 2 running trades. So I will need to open another pending order, which is 3 times the sell order. My sell order is 0.30 multiplied by 3, that will be 0.90. Remember, I originally have a 0.10 above. So if I remove 0.10 of my initial buy trade, my first trade, 0.10, if I remove it from the value gotten when I multiply 3 by 0.3, which is 0.9, if I remove 0.10 from 0.9, the result is 0.80. So after my 0.30, the sell stop gets tripped, then the pending order will be 0.80 lot size as a buy stop order. Okay, so the explanation is, if you place a buy entry, your pending edge trade will be a sell stop order. Now if you place a sell entry, if you execute a sell order as your first trade, then your edge trade will be a buy stop order for this strategy. So if you have a buy order running and you have a pending sell stop, and the pending sell stop gets triggered, then you have to place the opposite trade, which will be a buy stop order. If you have a sell order running as your first trade, and you place a buy stop order as the hedge trade, and that buy stop order gets tripped, that means price went against you and the buy stop gets tripped, then you have 2 trades running, then you have to automatically place a sell stop order. Now placing a sell stop order or buy stop order, you have to multiply the original lot size. Okay, you have to multiply the original opposite. We have to multiply the original lot size, which is the first pending order. You multiply it by 3. Now if that gets tripped and you have 2 running trades, then you have to ensure that at every interval the opposing lot size is multiplied by 3. Okay, so that's the way it works. So trading gold is a volatile commodity. Volatile in the sense that it is, especially when induced by news fundamentals, it moves in a rapid manner, because big banks, big corporate bodies, Many retail traders, like to trade gold, and it's a metal. It's a metal well recognized as a safe haven asset. So a lot of people put money in gold, so that contributes to the reason for the volatility of gold as a commodity. So when you have a commodity or you have an asset that is highly volatile, that price moves rapidly and covers a large number of pips within a short period, or it ranges in a large range, in a wide range, then you must have a strategy that you can use to make money while trading such commodity or such assets. You must have a strategy that will minimize your loss, that will minimize your drawdown. This is very, very important, so that you don't get to blow your account, so that you don't get to lose your money. And trading is something that you must constantly uh, educate yourself on, with what is happening, with events, with uh, strategies, with information, until you are able to come to a conclusion on what will work for you. Until you are able to come to conclusion on what will work for you. So gold trading is something that you want to do. Trading gold is what you want to do. I mean the electronic gold trade, not the physical gold trade. So trading gold is very, very interesting. It's very, very interesting. We have high number of people trading in gold than other commodities. We have high number of people trading more interested in how to trade gold than the normal forex uh, assets. Principally because uh, when gold price moves, it moves at a long range. Gold price moves in the long range, in the sense that on a normal day it can cover around 200 pips, 200 to 300 pips, and on a highly volatile day gold can move in thousands, in hundreds of pips, like 800 pips can make 900 pips movements, and then people smile to the bank. But on the flip side, uh, gold trading is not for small accounts, because people complain a lot about blowing their accounts when trading gold, principally because the account balance is small. Like you're trading gold standard account, and you are trading gold with a balance of $30 on a standard account. That will blow within a twinkle of an eye because it's small. And that is the more reason why I personally recommend a minimum of $300. You have enough room for price to move. Uh, Price to move. If you're trading a standard account with 0.01 lot size, if gold's price should move for 10 pips, that's $1. And if it should move for 100 pips, that's $10. So, and when we say on a volatile day that gold can move 900 pips, and when it moves 100 pips, you have $10. Then 900 pips, that's like $90. So if gold on a non-farm payroll day, NFP day, if it moves violently in one direction, and you just have a $30 account, that account is going to blow. It's going to blow. But if you have a $300 account, and you do not have stop loss in place, or you are hoping it will reverse and it keeps going and it goes for 900 pips, that's $90 drawdown on your $300 account. So what I'm saying basically is you do not need to trade gold on a small account. You do not need to trade gold on a small account balance with your standard account. Why don't you just open a micro account or a cent account and move your $30 to that account? Moving your $30 to a cent account, it will give you 3,000. It's going to give you 3,000 cents dollars. So if you have 3,000 micro dollars and you're using 0.01, 90 out of that is not even up to $1. You have a drawdown of 90 cents out of 3,000 cents. That's not up to $1. $1 is going to be 100 cents. So I hope you understand my explanation on the need to trade gold with the right money management. Money management in the sense that you have to use the right lot size for the right account balance. If your account balance is $50, definitely it's more for gold trades, because 500 pips on 0.01 standard lot size, the account is gone. You get a margin call. But if you change that standard account $50 to, if you change it to your standard account $50, if you change it to a cent or micro account, I'll give you 5,000 cents balance. So, and you're using 0.01 on 5,000 cents. That's going to give you it's going to give you, if you, the loss will just be 50 cents. 50 cents is not even up to $1, because the $1 on a cent account will be equals to 100 cents. So it's simple mathematics. Like for this illustration, this particular video, for this example, I have $70, which is giving me 17 cents. So instead of using 0.01, I'm using 0.10. Okay, so if I'm going to lose with my 0.10, if I'm going to make a loss of 500 pips, that would be 500 cents. That's $5 out of $70. So I hope you understand my explanation. We are looking at the settings for the parameters on the indicators on the screen. You can see relative strength index 80, 75, 70, 30, 25, 20, 50. This is just in case you want to set up if you want to set up the indicators for the indicators that you're seeing it on the screen. If you want to set it up, the parameters is being shown on the screen. Parameters of how you can set it up. Okay, you can see price going above my buy entry, just flickering around it. Okay, the chart is a 15 minutes chart, gold XAUUSD. All right, at this point marked green. Okay, that's for your buy entry. If the red line crosses above all other lines and price stays above that red line, you can always buy. Okay, that's a buy signal rather. You can place a buy signal when the red line crosses above all other lines. But here you can place your sell signal at this point marked green if the red line cross down below the blue line. Like you have a cross down below the blue line, whereas the blue line is below all other lines, all other moving averages. Then you can place your sell. When the blue line is above the gray moving averages, you have a bullish trend. Now, when the red line now cross above the blue line in a bullish trend, you can buy. Now, if the blue line is below the gray moving average, that's a bearish trend. And when the red line now cross below, down below the blue line, then you can place your sell trade. So that's that for the main chart. For indicator window one, when the orange and red lines, when they get below the lower band of the envelopes, okay, and then it starts to go up, you can have your buy signal. Same thing for a sell signal when it goes above the upper moving average band and then drops below the upper the upper envelope band, then you can sell. That means you have a sell signal. So like this is a sell signal I've just highlighted here. The sell signal when it drops below the upper band, upper envelope band. So when it goes above the lower band, that's a buy. It's a buy signal. So trading gold is very interesting but volatile. Very interesting but volatile. Okay. For indicator window 2, when the blue line crosses upward on the 50 level, is a buy signal. When it crosses downward on the 50 level, 50 RSI level, is a sell signal. When it crosses up on the 50 RSI level, it's a buy signal. When it crosses down, it's a sell signal. So that's for the indicator window 2. For indicator window 3, where you have ATR. ATR is basically for measuring your stop loss and your take profit. ATR is for measuring your stop loss and your take profit. Right now, the ATR as at that last candle is 3.63. 3.63 ATR value for the last bullish candle that the crosshair is upon. Okay, and you have the open price above, the high price, the low price, and the close price. Okay, and your ATR is around 3.58. So what you do is measure the ATR value, measure it from the low of a bullish candle, measure it, then your stop loss will be below the measurement in a bullish price move. Okay, so you get the ATR value, you add it to the low price, okay, and measure downwards. So the low of your measurement, the lowest point of your measurement is where you place your stop loss. And same thing for a buy, like you had for measurement, you subtract your 3.63 value from the low of the price. Subtract it from the low of the price, and that's you can see. You subtract the low of the price, you subtract 3.63 from that, it gives that red shape. So the lowest point of that red shape is where you place your stop loss. So ATR is just the factor or the value or the ATR value of that candle. Okay, you remove it from the low, you measure it downward from the low point of a bullish candle. The base will give you a stop loss. Then if you now have 1 to 2 risk reward ratio, you can multiply the ATR, the stop loss to low. You can multiply the height from the stop loss to the entry. You can multiply it by 2 or by 3 factor. Okay, for you to get your take profit. Like this ratio 1 to 2. Okay, so you measure the stop loss to the low or entry price. You can measure the stop loss to the entry price. You can measure the stop loss to the low price and now measure it, multiply it by 2. So the height will give you your take profit. Like the red area is your stop loss area. The base will be where you place your stop loss. And the green area is your take profit area. The top will be where you place your take profit. So that's basically the essence of the ATR. So measuring stop loss and for measuring take profit. Of course, when the ATR is up, it shows that volatility is high. And when the ATR is low, I'm talking about the blue ATR line, when it is at the base, when it drops down, that shows volatility has dropped. So the illustration on the screen is when you are measuring ATR for a bullish candle. Okay, for a bearish candle. For a bullish candle, you measure the ATR downwards for you to get your stop loss at the base. But for a bearish candle, you measure the ATR upwards. So you add the value of the ATR from the high point of the bearish candle upwards. That gives you your stop loss above the bearish candle. Then, of course, take profit will be ATR times 2, ratio 1 to 2, and that gives you the green area. The base of the green area that I've just drawn is your take profit, and the top of the red area is your stop loss. So ATR basically is for calculating your stop loss and your take profit. Also for knowing when there is volatility in the market. When the ATR line on the indicator window 3, when it starts to tilt upwards, then you know that volatility has entered. The market is now volatile. So if price is now going upwards at the point where market is volatile, then, and you can check it with all other indicators, are they also going up? All other indicator windows, are we having a buy signal? Then you can know you can enter your buy trade. Now when you enter a trade, you must have the stop loss in mind. Like you can see on the screen, the stop loss will be at the base of the red candle. Okay, for the candle before the last formed candle, not the current candle. The current candle is a small bearish candle, but the candle before it is a bullish candle. So I can see for the ATR we added 3.63 to the low of that bullish candle to give us that red shape, and the base of the red shape is the stop loss point. Okay, our take profit will now be for risk reward ratio 1 to 2. Take profit will be above the green line where you have 1786.5. So that is that for this indicator settings. The parameters for the main chart, for indicator window 1, for indicator window 2, and for indicator window 3. Okay, the last explanation is basically for how you can use the indicator window 3, which is your ATR indicator. Okay, when the ATR line is tilting upwards, that means you have increase in volatility. When the ATR line is tilting downward, that means you have decrease in volatility. Of course, when the ATR is tilting downwards, the ATR line, I'm talking about the blue line on indicator window 3, if it's tilting downwards and you have a sell signal on indicator window 1, you also have a sell signal on indicator window 2, then that could give you a confirmation that price is going to go down. But if the ATR line, the blue line on the indicator window 3, that's the lowest window, if it's tilting upwards and you have a buy signal on indicator window 1, and you also have a buy signal on indicator window 2, that's the alignment is your confirmation that you can enter a buy trade confidently. Now, when you enter a buy trade or a sell trade, whatever trade you enter, you must have in mind where you are placing your stop loss. This is very, very critical. You can determine where to place your stop loss by measuring or looking at the ATR factor or the ATR value on indicator window 3. Currently on indicator window 3, the ATR value for this current candle is 3.6. Okay, so if this current candle ends up as a bearish candle and you want to place sell trade, you want to open a sell order, then you add 3.3 from the high point of this current candle. But I'm talking about when the candle closes, not when it's still running. After the candle has formed, the current 15 minutes candle has formed, and it closes as a bearish candle, the ATR will be added at the top for you to determine the stop loss for the bearish or the sell trade. But if this current candle closes as a bullish candle, okay, that means it closes as a bullish candle, closes above, the closing price is above the opening price, then your ATR value will be added at the bottom. It will be added from the lowest price of the current candle, current bullish candle, downwards. So your stop loss will be at the base, and then your take profit will be on top or above. Now, it now depends on the risk to reward ratio that you want to use. Are you using risk to reward ratio 1:1, or you are using risk to reward ratio 1:2, or you are using risk to reward ratio 1:3? It depends on the risk to reward ratio that you want to apply. Now, even if you use risk to reward ratio 1:1 or 1:2 or 1:3 or 1:4 whatsoever, you must have in mind that you must apply trailing stop, or whenever price have moved above your trade or below your trade and you are in profit, you must ensure that you apply trailing stop. Applying trailing stop is moving stop loss into profit area to protect your account. If you have a profitable trade, that is when price is in profit, is in a profit area, and you can see that you are making profit, there is a need for you to manage your risk management. Risk management in the sense that there's a need for you to move stop loss. Okay, trail the price with your stop loss. Trade price and stop loss in the sense that if price goes against you, it will trip the stop loss and you will close the trade with a small profit. But we have scenarios whereby traders will open a trade, they have a stop loss in mind, and they have take profit in mind. Price goes into profit and almost get to their take profit, but at the point of touching the take profit to close the trade, price reverses and then ends up going back into loss and then triggering the stop loss, and then the trader ends up losing the trade and also losing the amount portioned for risk. So, but if the trader has already placed the stop loss when the trade was in profit, if the trader has placed the stop loss at the point of profit just above the or below the entry point, if the trader has done that, by the time the reversal occurs, price will close the trade will close in small profits, and the trader can still continue to trade.